I last updated you about Zagga during March, just at the start of the COVID-19 pandemic. And since quite a lot has happened since that, I thought I would issue you another update just to give you a sense of where we are at today, now that we're almost into September. So just in terms of overall, I'm pleased to say that the Zagga book has grown quite markedly over the last few months. Originations now are close to $350 million. The active book is around $165 million. We've done nearly 100 transactions, and during August alone, we'll be funding about $35 million, which is one of our largest single months ever. We also have a large pipeline building, and there'll be a number of differentiated loan opportunities coming through over the next few months. The book is well diversified. There's an even split between construction and non-construction property assets. And the book is mainly spread between Sydney and Melbourne, although it's weighted more on the Sydney side than the Melbourne side. The average term of the book is around 10 months, and the average LVR remains consistently at around 61%, which leaves us a lot of room for comfort, especially in the event that property prices diminish or a loan suffers some form of distress, which I'm pleased to say right now is not the case. In fact, other than for one small loan in which there are only two investors invested, the book is performing exceptionally well and in terms of contracted expectations. As regards the underperforming loan, we're at a very, very comfortable LVR. We're in the process of recovering on that loan, and the two investors will receive their capital, their interest, plus their default interest, and all costs will be recovered as well. So there'll be a perfectly good outcome to that. The only reason for that loan being in default is as a result of COVID-related difficulties rather than anything fundamental happening with the loan. It's important that I point out to you at this point in time, as I have previously, that should you be invested in a loan and should something go wrong with that loan, we will always tell you what has happened, what we intend doing, and tell you what options are there remain for us to recover your money. As I said, I'm pleased that we haven't really had to do that other than once over the 100 loans that we've written, and that will have a good outcome. So now that we're entering month 7 of COVID-19 and we're all getting used to kind of the new world order under the pandemic, I think we're seeing a number of things relative to Zagga which are worth mentioning to you. The first is that there's been a definite improvement in recent months in both the quality and size of the loan opportunities we are funding. I think this is really as a result of an initial absence of capital and funding in the market, coupled with the slowness of banks to respond, and certainly the banks now being very picky and choosy about what they write, and also the absence from the market of a number of previous participants, either who have lost their capital and are no longer funding, or who may not be in business or are suffering from some form of illiquidity. As far as Zagga is concerned, we prefer to write fewer larger loans, where the effort on our part in getting the loan out the gate is much the same, but we're dealing with a much better security package, a better borrower, better guarantors, and with counterparties that are stronger and less susceptible to non-performance than would be the case in the smaller loans. So we're comfortable now with our loan sizes moving up and with the kind of deals we've currently been writing. We're also seeing the return of investor appetite, not unexpectedly when the pandemic hit us. Investors were very scared. They were cautious, as we all were. Nobody really knew what was coming. But we're kind of getting used to the new normal now, and investors are beginning to understand that they need to find a home for their money. They need to make their money work for itself, and they certainly need to actively manage their investments. So we're beginning to see a lot more money coming into our business. We're also beginning to see now a marked difference in the risk metrics between Sydney and Melbourne. They used to be pretty similar, but Melbourne, as a result of the pain it's currently going through, is now experiencing a much different risk profile to that it did previously. And obviously, we have to take this into account in the way that we assess loans and those kinds of things. As always, our internal and external credit teams are on top of all of the loan opportunities. We do an exceptionally deep dive and due diligence into all of these opportunities. And in addition to that, our team generally is keeping a very close handle on all of the other developments around COVID, whether they be legal, commercial, operational, or the like, to make sure that not only are we selecting the best opportunities for you, but at the time of making that selection, we're up to speed and up to date with all the relevant information that we need. There's no doubt that the market experience of our team, both internal and external, has allowed us to select very good opportunities to date, hence the performance of our book. And we're mindful that we're only as good as our last victory. So we have absolute focus, commitment, and intent to make sure that any loan opportunity that we offer has been through the most rigorous due diligence that we can give it. It's not for me to deliver an economic forecast, and it's not for me to advise investors on how to structure their investment portfolios. We certainly don't have a crystal ball and cannot see into the future, let alone during these exceptionally unstable and troubling times. That said, we do believe in investor first. That's the raison d'etre for our business. And that means that we're focused on primarily preserving your capital and thereafter giving you a decent conservative return without exposing you to unnecessarily incommensurate risk. We're not here to deliver the alpha on your portfolio. We're here to deliver an annuitized, transparent return to you, and one that you can bank on. As I have mentioned many times, our mission at Zagga is to deliver a safe, risk-mitigated, transparent return to our investors. We believe in running our business with uncompromised integrity and complete transparency, and we believe that our investment loans fit well within any diversified portfolio. The average return across our portfolio is well ahead of 8%, and on an IRR basis, it's well over 11%. And we believe that most investors would be very happy with that for the cash component of their investment strategy. Let's bear in mind that the cash rate has reduced by more than 100 basis points over the year. It's currently at 25 basis points. The RBA has signaled that in need it would reduce it even further, although one doesn't really want to see that. And right now it's hard to see economic conditions improving in the near future. In fact, the best for us is probably that they will stay the same. That said, many commentators are anticipating doom and gloom, but as I said earlier, it's not for us to speculate on that. It's only for us to manage within the conditions as we see them. If you have your money in the bank right now, it's returning almost nothing. The 12-month term deposit rate in some banks is less than 1%. And with this in mind, we envisage a reduction in borrower rates on new loans going forward, especially as capital starts to return to the market and it's not as scarce as it was a few months ago. And that will probably bring with it a commensurate reduction in investor returns. So we see investor returns moving to somewhere between 7 and 8% per annum, which if you look at that in the context of a 1% term deposit rate is still an exceptionally good return on your money, bearing in mind the risk profile or lack of risk profile to which you're being exposed. So we probably see the target return for our Zagga feeder fund, if you're invested in that, also moving to within the 7 to 8% range. Obviously, we will strive to deliver the best return possible there, but we're mindful of the fact that we'd rather not write loans which are going to expose you to unnecessary risk just for the sake of giving you a slightly higher yield. At the end of the day, we need to be conservative in our outlook. Lastly, perhaps the point I'll make is that property has always weathered the storm. It will continue to weather the storm. That's not to say that certain sectors of the property market won't go through potential strife and difficulty. It's not to say that prices won't be volatile and will fluctuate, but over the course of time, there will remain a demand for property and it will remain a solid asset class. And we're quite comfortable with the security packages we have and the LVRs that we have. So other than that, I really just wanted to thank you all for your support to date. We've now gone through our 3rd anniversary. I think that we have credibility in the market. We're certainly beginning to be recognized out there, and we appreciate that that's only because of those people who have supported us, both on the investor side and the borrower side, and of course our team. And as always, if you need to chat to us about anything, feel free to email us on info@zagga.com.au or reach out to me personally or to Steve Levy on our email addresses or our phone numbers. So until the next update next week or soon thereafter, be well, take care and stay safe, and we'll see you soon. Thanks and bye-bye.